Read any investment article or watch any YouTube video and everyone says buy low, sell high. That's the way to make money. And it does sound really simple. Good timing is all you need to reach your financial goal of becoming rich and having financial freedom. But here comes the important question. Is that actually true? Is timing all you need to make your millions? The short answer is no. So in this video, you're going to learn why buying at the bottom of the market isn't what it's cracked up to be and what to do instead. Hey friends, welcome back to the channel. I'm Ed, an economist and property investor here at Opus Partners. And implicit within this idea of buying low, selling high is that if you buy a share in a company like Apple or Coca-Cola and you buy it for $10, the price eventually goes up to $20, so you sell it and you've made $10, you've doubled your money. You then wait for prices to go back down. Maybe you buy that same share again for a lower price. Let's call it $15 this time. Then you wait for the price to go up again. Now it's $30. You've doubled your money. Sell that share. You've made another $15. Easy, right? Well, the issue is that real life doesn't quite work out like that. So a friend of mine, Sim Kerr, she wrote a great book, Girls That Invest. And in that book, she gave an example of three investors. First up, we've got Jacob, and he thinks he's got the sixth sense for picking the exact bottom of the market. So he puts aside $200 a month, he saves it up, and then he invests exactly when he thinks it's the bottom of the market. But it turns out that our mate Jacob is the unluckiest investor in the world. It's not that he has a sixth sense for the market, it's that he has no sense whatsoever at all. And he always invests at the peak of the market. Now, if Jacob did this for the last 40 years, he would have invested directly before all four major market crashes. But despite all of that, he still would have ended up with $664,000. So he put in 96 grand of his own money and he got over $500,000 in investment returns, even investing at the top of the market. Right, let's meet our second investor, Afia. Now, she is a market timing genius. She doesn't just have a sixth sense for the market, she's basically got a 10th sense. She saves up her $200 a month diligently, exactly the same as our first investor, Jacob. And as soon as the market crashes, and as soon as it hits the precise bottom of the market, she puts all her money in. She is investing exactly at the absolute lowest point after each big crash. Then she goes back to saving, waiting for the next big one. Now, if she did the same over the last 40 years, she would have ended up with $957,000. So just like Jacob, she put in the same amount of money, 96 grand of her own money, but she didn't make roughly $500,000. No. She made $861,000. Her good timing basically meant that she made 50% more money than Jacob did. But then we've got one final investor. Her name's Nina. And she doesn't care about whether share prices are up. She doesn't care whether they're down, come rain or shine. She just puts in $200 a month into her investments. If the market's up, she buys. If the market's down, hey, she buys. The world's on fire, she is still buying. And this is what the investment industry calls dollar cost averaging. You don't worry about what's going on the market. You just put the same amount of money in every single time. Now, you would think that Nina would make the amount of money somewhere between Jacob and Afia's returns. Like more than Jacob, who had the worst market timing, but not as much as Afia, who had the best market timing possible. Well, it turns out that Nina would have a whopping $1.38 million at the end of those same 40 years. Now, I know you might have a million questions and think, well, this is really strange. How did this happen? How is it possible that someone who times the market perfectly makes less money than those who just invest consistently? This doesn't really make any sense. Well, just before we get into the numbers, if you like videos like this, it makes investing really, really simple. Do me a quick favor and hit the like button. That's how I know what sort of videos you want to see more of, and honestly, it also helps out the YouTube algorithm. Hitting subscribe, that helps too. We are almost halfway at our goal of growing this channel to 50,000 subscribers. So how is it that timing the market perfectly makes less money than blindly investing no matter what happens? Well, if we come back to that idea of buy low and sell high, most people assume that buying at the bottom of a crash gives you the lowest possible price. But that's not actually true. So property and investment cycles don't just go up like this, where property or share prices start at $100,000, they end at $200,000, then they go back to $100,000 and go back up to $200,000. Instead, investments and assets tend to go up in value over time. They have corrections and then they continue going up over the long term. And just last weekend, I was on News Talk ZB, New Zealand's largest radio station, and I was talking to Jack Tame about investments. He's the presenter. And I said to him, Jack, did you know that the S&P 500, which is a share market index, that bottomed out in October 2022. But if you had invested at any point before November 2020, about 2 years earlier, you would have got a lower price than the bottom of the market. I'll tell you what, there was another bottom of the market that happened in March 2020. That was during the COVID pandemic. Great time to buy. But if you had invested at any time before February 2017, you would have got a lower price. Now, remember, this is a property investment YouTube channel, so let's look at property prices as well. If we look at Auckland, property prices bottomed out in July 2024. But again, if you bought any time, any month before September 2020, you got a lower price than that bottom of the market. Property prices also bottomed out there in December 2008, but if you bought at any time before January 2006, you got that lower price. So time and time again, we see that getting into the market early tends to give you that lower price than waiting for the market crash, because we live in a world where asset and share and property prices tend to increase over time. So buying earlier and consistently is often better than buying at that right time. And that's before we even get into arguments about, is it actually possible to know exactly where the top or the bottom of the market is? Well, you probably can't. So sometimes it's better to invest no matter what, and sometimes you'll win, and sometimes you'll lose. I remember I bought one of my early investment properties in 2019. It was right before property prices took off like a frog in a sock. And I wish that I could tell you that I'm a market timing genius, because that property is probably worth about 50% more than I bought it for. Unfortunately, I'm not a market timing genius, because I also bought another property in November 2021, right at the peak of the market. And while that specific property has beat the market, it hasn't gone down in value as much as the average property in New Zealand. It still has made a loss for me so far. But then I also know that, just like Jacob, if I just hold on to that investment over time, it's still likely to make money. Just like if you bought at the peak of the market at any point previously, you still would have made good money. But throughout this video, we're going back and forth talking about this idea of dollar cost averaging, and we've been going between examples for both shares and property. But the thing is, it's really easy to buy $100 of shares a week, because shares aren't particularly expensive, but properties are. You can't spend $500,000 or more on an investment property every single week. So how can we still use these concepts of dollar cost averaging with property? Many of the investors we work with here at Opus Partners aim to buy a property every 4 years. And to keep this really simple, let's say you just invest in Auckland. Well, starting in the year 2000, you just blindly buy a property every 4 years, and that is the dollar cost averaging scenario. Over the next 25-ish years, you would have bought 7 properties and have spent $4.2 million on those properties. Now, some would have made money, some would have not made as much money, potentially lost some money, but overall, you're up $3.32 million. Now, you'd be pretty happy with that. Now, let's say we run another scenario. This time you get your 6 cents going and you perfectly time the market, only buying at the bottom. So in this case, you could see that property prices bottomed out in October 2000, and again in 2009, and again in 2015, and again in May 2019, and so on. And to keep things the same, you also invested $4.2 million. That's what you spent on those properties. But in this example, you only made $2.9 million. Now, let's be real, it's still really good. But in this example, you would have made $440,000 more investing blindly rather than perfectly trying to time the market. Now, if you start the same example at a different time or in a different city, you will get a slightly different answer. But the point is the same. Waiting for a market crash usually makes less money than just routinely and regularly investing. So don't feel like you need to stay up to date with every single last happening in the investment markets. Most of that is just noise compared to investing for the long term.